It's the middle of the morning. You're in your office waiting for the market to open. You've got your coffee and sticky note in hand. You have a solid plan for the day. You know exactly what you're going to buy, what you're going to sell, and what the rules are. You're waiting for your account to load. But just when you have your order built out and you're about to click send, you feel this wave come over you, this moment of hesitation and doubt. You see the screen flashing and the number jumping around like leaves in a windstorm, and suddenly you're terrified of making the wrong decision. You freeze. You're overcome with fear and anxiety. If this has ever happened to you, then this video is for you. Because you see, there's a difference between knowing the path and walking the path. All the planning and research in the world doesn't mean anything when in that moment of action, the fear takes over and you feel that cold drip down the back of your neck. It's in moments like this where less experienced traders make emotional decisions. In situations like this, you often lose the trade before you even hit send. This is where a professional will win the trade and win the investment before they hit send because they are able to follow their predetermined rules and strategy with mechanical process and precision. And today's video is all about building out and refining that process. You're going to learn 2 tactical if-then rules to help make your trading and investing more mechanical and more predictable. We're going to have one for entering positions and one for exiting positions. And then we're going to have a bonus rule for how to manage your overall strategy. The goal is after this video, you'll go from being paralyzed and overcome with fear, doubt, and anxiety to being able to act with mechanical precision. Let's get started. But before we get going, I'm going to put a free PDF link in the description below for all the rules for my 200-day strategy if it's something that you're interested in. Check the link in the description. Our goal here with this system is to help eliminate emotional responses as much as possible and become purely mechanical. You almost don't even have to look at the screen to see what's going on. You can simply type in the order and hit send, walk away, and be done with it. Remember, the strategy is if price closes above the 200-day moving average, we buy or hold the index long. If price closes below, we switch over to buy gold. We sell SPX and we buy gold. Let's dig into exactly what that looks like. The first buy rule for the 200-day strategy is this. For every 1% price closes above the 200-day moving average, you take that many days to build out your position. What that looks like. If price closes 1% or less above the average, then you build your position in one buy order in one day. If price closes between 1 and 2% above the average, then you spread your position out over 2 days. If price closes 2 to 3% over the 200-day, you spread your position out over 3 days. Specifically what we're looking at is this day right here. This is Wednesday, March 4th of 2020. We're at the height of the COVID pandemic. Prices moved down off all-time highs, checked the 200-day, and then moved back above. We assume that on the previous day we sold because price closed below. Now we're going to execute a buy order because price closed above the 200-day moving average. So using our new rule, for every percent the price closes above the average, we want to spread our order out over that many days. The 200-day moving average here is 30.51. Price closed at 31.28. That's a 2.5% close above the average. We would want to spread our buy position out over 3 days because it's between 2 and 3% the very next day. Thursday, March 5th, price closes back below the average. This is exactly why we use this rule. Perfect example. On big moves up, when volatility is high and there are large swings in price, this is what can happen. And if you look here on the chart, you can see that from the 27th of February through the 5th of March, price closed below one day, skipped a day, and then went back above, below, above, below. This is what we're trying to avoid. When price is doing this, when volatility is up and we're seeing these big movements in price, this is what we're trying to avoid. Using this rule on this day, we would have spread our buys out over 3 days, but the very next day price closed below, so we didn't get a full position. That means we would have got stopped out. Yes. We would have taken a loss on this trade. Yes. But it's a third of what it would have been. So this reiterates the most important part of trading that I want you guys to understand when you're learning how to do this, and that is risk management. Our main concern is making sure we don't lose more money on the way down because we can make money on the way up, right? What's going to determine your success as an investor and as a trader is cutting your losses from a 10% loss to a 7% loss, keeping your losses as small as possible, and then just letting your winners run as long as possible. So again, risk management is really all that matters here. And that's what this rule is set up to help you with. Another example here, if we go back to 2018, let's look at beginning of April. We're looking at Tuesday, the 3rd of April here. We see that price was below the average on the day before, potentially closed our position there. but then the next day it closed above, right? And this was actually a 2% move above the average. So we would have been looking to spread our buys out over 2 days. The next day, we also had a possibility of getting in close to the average. By spreading your buys out over time, you give yourself the opportunity to take advantage of price coming back to the average and you being able to buy in closer to your stop loss. That can potentially really help your returns. If your stop loss is at $2,000, for example, and you're able to buy at 2001, then you're really only risking a $1 spread. That's the idea here. Not only can this nuance help protect you from losing as much money during times of volatility in the market, it can also help you get better entries. So you're limiting your downside and potentially enhancing your upside. And look, there's no guarantee that any of this is going to happen. And that's the point here. We don't know what the market's going to do. Just because it's done something in the past doesn't mean it's going to do something in the future. The best we can do is put the odds in our favor and then make our highest probability decisions based on those odds. The next rule has to do with our sell criteria. So up until now, the sell rule for the 200-day strategy has been this. When price closes below the 200-day moving average, you sell and then buy gold. However, we're going to add the nuance in of if price closes below the 200-day moving average, you use the absolute low price for that day as your stop loss. If price closes below that stop loss, you cut your position. In this case, sticking with the same example, let's look again at 2 April 2018. Price has been above the 200-day moving average. It's coming down, making lows. Test the average, and on 2 April, it closes below it. But in this case, we're not going to sell because price is below. We're going to say price closed below. Now we're going to use that low of day as our stop loss. If price closes below this point, we get out. And what you can see here on the chart, price never came back and touched that. We would have avoided getting out and then getting right back into the market the next day or a couple of days later. And in this case, that would have actually negated buying back in over multiple days the next 2 days, right? We would have avoided getting stopped out there and been able to stay in and hold our position. And you can look and see from there, price moved up, the average moved up. Let's go back to the COVID example. We're looking at March of 2020, looking at March 3rd. On this day, let's say we bought back in the previous day, we had a position, price closed below the average. We're going to use the low of that day, mark it again, as our stop loss. Price the next day, we're still in. We wouldn't have had to worry about spreading our buy positions out over multiple days. Here's how this rule functions. When price closes above the average, now you take that stop loss off. Now the rule resets. You don't use the stop loss from the previous time price was below the average. Once price gets back above, your stop loss is cleared and you set a new one. Now your stop loss is higher. How that would have worked on March 4th, the next day, price closed above, we clear our stop loss. Price is now back above the average and we're going to be looking to generate a new one. The next day, March 5th, price closes below. We take the absolute low of that day, which is now higher. You have a higher stop loss. Potentially you're making more money. You're selling at a higher point. Now that's the point at which you exit. In this case, it is during COVID. Price gaps below your stop loss. You sell the next open. However, in this case, there's another kind of nuance here. As you can see on the chart. On the 27th of February, 2020, price closed at the low of days. If price closes at the low of the day, when price closes, that is the lowest point it's been all day, you want to sell there. If the absolute low of day is the closing price, then in that case, you sell. So review the full sell criteria for the 200-day strategy. If price closes below the 200-day moving average, you use the absolute low of that day as your stop loss. If price closes the low of day, you sell. If price gets back above the average before your stop loss is hit, then you clear the stop loss and you reset the condition for the next time price closes below the average. So that's how the sell rule works. If you combine the absolute low of day stop loss with spreading your positions out over multiple days based on how far above the average price closes, this improves the performance of the 200-day strategy from about that 696% level over the last 25 years up to over 700%, up around 714% performance over the last 25 years just by adding in little tweaks with your buy and sell criteria. So you outperform the market even more. Those are the basics of building a position and letting the market determine your stop loss for the 200-day strategy. If you want to see the complete 200-day strategy and how to execute, including the full set of rules and how to apply them with examples, check the link in the description below. I put a free PDF with all of the rules, how to apply them, and examples just like this. So you can use the 200-day moving average strategy, including the gold component, to successfully defend your investments during times of uncertainty and high volatility, and put you in a position to take advantage of that fear and grow your capital during those same times of uncertainty. See the full set of rules that helps you more than double the returns of the S&P 500 over the last 25 years, including these tactical nuances to help you execute flawlessly and consistently without your emotions clouding the picture. Check the link in the description below. Again, this is the perfect way to get started with investing or trading. Start out with indexes, start out with shares, use the 200-day moving average, learn the concepts, see how these things work, and as you grow and learn over time, you can expand your portfolio of investments and strategies and trades. As you start doing that, as you move along your path towards financial freedom and escape velocity, you start buying into other asset classes. You're going to need to adapt your rules and come up with a way to manage your entire portfolio, to manage your trading system. Because over time, even the most optimal system is going to change because the market changes. So to do this, I'm going to have to introduce the concept of something called the first categorical imperative. Let me explain what this is to you and give you an example so it's a little more clear, because it can sound like this really complex academic thing. The categorical imperative says when you make a decision, that decision should be able to be turned into a universal law that is applied to that circumstance and that situation forever, regardless of outcome. And that last bit is very important. Regardless of outcome, this is the decision that you made. If you're not willing to do that every single time I'm in this situation again, forever, then you're making the wrong decision. So why is this so important? Let's apply this to a real world example so it makes a little more sense, because I know if you're not familiar with philosophy or decision-making science, this can seem like, what the hell are you talking about? Let's take, for example, going and shopping at the grocery store. And every week you buy a pack of chicken breast. And let's say they're $10, right? And that's what you do every week. Today, you go to the grocery store and the chicken is buy one, get one. So you can get 2 chicken breasts for $10. And you decide that because it's buy one, get one, instead of getting 1 pack, I'm going to buy 2 and I'm going to get 2. Instead of spending $10, I'm going to spend 20. Because this situation exists, when it's buy one, get one, you spend more money because that means you're going to save more money. The categorical imperative says now, every time you come to the grocery store, forever, if chicken is buy one, get one, you buy 2 and get 2 forever. The categorical imperative also says that you could apply that same rule to, say, buying meat. It's not just buying chicken. Let's say we're going to apply this to buying meat. Anytime steak is buy one, get one, you get twice as much as you normally. Anytime salmon is buy one, get one, you buy twice as much as you normally. But that's how the rule works. Okay. Why do you do this? Well, you do this for a few reasons. One, it saves you mental energy. You know that when you go to the store and when you go to buy chicken, you don't have to decide how much to get. If you go to the store and it's buy one, get one, then you buy 2. Those are your 2 conditions. It's either buy one, get one, or it's not. If it's not, you buy your normal quantity of 1. If it is, you buy twice your normal quantity. You don't have to spend energy making the decision. You reduce your decision fatigue. Now, I know that may not sound like a big deal, just fucking buying chicken, but put yourself in this situation. You get to the grocery store. It's pouring rain outside. You live in Central Florida. It's dumping. You have to run inside the grocery store. You get there. Now your shoes are wet and squeaky. You're slipping all over the store. You're cold. You're wet. Okay. And you forgot your shopping list. Damn, what am I going to get today? You have to think about all the things you're going to get. And then let's say your spouse texts you, make sure to get this. Let's say something from work comes up. You have to stop in the middle of the grocery store and respond to an email or take a phone call, right? Now you're cold, you're wet. You don't remember what your spouse said to get. You just had to answer something from work and you forgot your shopping list. You can see how all of these little stressors start to add up. Making decisions based on the categorical imperative, you have less decisions to make. When it comes time to buy meat or buy chicken, that reduces that cognitive fatigue. And maybe because you're able to reduce your cognitive fatigue, you don't snap at your kids when you get back outside or when you get home. You don't snap at your spouse because you're stressed out from going to the grocery store. This allows you to make better decisions because your stress level is reduced. This is what the categorical imperative is here to do. It's here to protect you from those negative feedback loops. And if you find yourself in a new situation, let's say you go to the store another day and chicken is buy one, get 2 free, right? Now you can make a new decision, a new circumstance. So your decision set is able to adapt and evolve as you come across new circumstances and new situations. But the big reason to use a categorical imperative, in our case, when we're talking about investing, we're talking about trying to obtain financial freedom and escape velocity, is that using the categorical imperative helps you build discipline because you take a rule You take a circumstance that you're in and you have lots of different decisions that you're going to have to make. And you find some, you isolate some that seem to be the same kind of thing every single time. And you say, I'm going to take this complex set of decisions and break it down into its pieces. And some of these things, I'm going to do the same thing every single time. That's all discipline is. It's a positively reinforcing habit. In life and in trading and investing, discipline is your shield against losing money in the market. What I have to offer you is a way of thinking. And that thinking is built on discipline. If this is something that you have struggled with or something that you do struggle with. Building discipline, having good habits, executing your system, sticking to your rules. You've tried to trade or invest in the past and you've failed. Maybe you're currently failing. Then I want you to watch this next video. Because like I said earlier, there's a difference between knowing the path and walking the path. And then beyond that, there's a difference between being able to stay on the path when the storm sets in and you aren't sure what's going on. You're not sure what the next step is. You're not sure if you're taking the right steps on your path. That's when discipline will save you. Because in those moments are when your emotions can set in and steer you towards disaster. The path of investing and trading can be very lonely. So when the screens go live, the market opens, the screen starts flashing, the numbers are jumping around, find yourself overwhelmed, you're not sure what to do, you struggle with sticking to your system and your rules, then this next video on unbreakable discipline is for you.